It's pretty staggering when you think about it. How many new rules, regulations, businesses have to juggle?
Oh, absolutely. Tens of thousands every year, just in the US. It's a
It's
lot.
a massive headache, right? And that's kind of where FiscalNote comes in. Ticker note on the NYSE, they're using AI tools, trying to bring some clarity to all that chaos.
Exactly.
But then you see the stock price, around 64 cents as of yesterday's close, April
Yeah.
28th, 2025. And you think, what's really going on there?
It makes you wonder, and that's what we're doing today in this deep dive. We're looking at FiscalNote Holdings, Inc., Note, from a value investing angle.
Okay.
We're using a pretty comprehensive report, the Stock Deep Research Framework, dated today, April 29th, 2025. It pulls from, well, over 30 sources.
30 sources.
Yeah, SEC filings, news articles, financial data providers,
Yeah.
the works. Gives us a really solid foundation for the analysis.
So our mission basically is to cut through all that complexity and figure out,
Yeah.
is FiscalNote, even with that low stock price, a potential hidden gem for value investors? Or are the problems just too big?
That's the core question.
We've got 70 chapters lined up. First, understanding the business itself.
Yeah.
Then management, financial health, of course.
Yeah.
Then in the second half, market sentiment, who owns the stock, a risk assessment, that SWOT analysis, and then we'll wrap it up with some conclusions.
Sounds good. Let's get into it.
Okay, let's dive straight into chapter 1, business understanding. What is FiscalNote actually doing? What's their main thing?
Right. So at its core, FiscalNote is a SaaS company, software as a service.
Okay.
They provide AI-driven intelligence. Think policy, regulations, global affairs, that sort of thing. And what's really interesting, especially for stability, is their revenue model.
How so?
Well, in fiscal year 2024, 92% of their revenue came from subscriptions. That's recurring revenue.
92%. That's high. That suggests predictability.
Exactly. A lot of predictability baked in. The other 8%, that comes from things like advisory services, advertising, CQ and roll call, their media brands, and some other bits and pieces.
CQ, roll call. Right. Heard of those.
Yeah, well-known names. Though that smaller segment, the 8%, it did see a 24% drop year over year in Q4 2024.
Ouch.
Yeah. But if you strip out some discontinued products, the underlying drop was more like 4%. So context matters.
Okay. And their main goal, what are they trying to achieve for clients?
Essentially, they want to help clients navigate all that political, business, regulatory risk we talked about. They use their AI, their data, and also human expert analysis to do that.
So giving businesses a clearer picture of what's coming down the pipe, policy-wise, what specific products help them do that?
Good question. Their big focus right now seems to be PolicyNote. That launched in January 2025.
PolicyNote, okay.
Yeah, it's meant to be this unified AI-centric platform, bringing everything together. But they also have those established brands like CQ, Congressional Quarterly for nonpartisan policy news and analysis.
Right.
Roll Call, which is more focused on Capitol Hill itself. Voter Voice, that's their advocacy platform for running grassroots campaigns. And Fireside, which is a tool for government offices, actually, for managing constituent relationships.
So a range of tools. Anything else new?
Yeah, a couple of recent things. They launched a tariff tracker in April 2025, which plugs into PolicyNote. Seems timely.
Very timely, yeah.
And something called Stress Lens. It's an AI agent for assessing human risk. They actually landed a multi-billion-dollar asset manager as their first customer for that.
Wow. Okay, so innovation is happening. Now, where do they sit in the market? Big player, small fish.
Well, they call themselves a leading provider, and they've claimed in the past to serve over half the Fortune 100, so, significant client base.
Yeah.
But then you look at their market cap, around $100 million right now. That puts them squarely in the microcap space.
Microcap. Okay, so not a giant compared to big tech or info services companies?
Definitely not. They have a global footprint, offices in North America, Europe, Asia, Australia, over 570 employees. But yeah, that market cap tells a story about their current scale.
Right. So what's the core value they're selling?
Yeah.
Why would a company sign up?
It really boils down to providing mission-critical insights. That's their pitch. Giving organizations the tools to understand and react to changes in policy, regulation, geopolitics.
Making the complex simpler, or at least manageable.
Pretty much. Using AI for the heavy lifting on data, combined with human expertise for the nuance. It's about offering transparency, helping manage risk, make better decisions, and hopefully get a competitive edge.
Okay, so summing up, SaaS subscriptions for platforms like PolicyNote, CQ, Voter Voice. Value is that blend of AI, data, human analysis. You mentioned a strategic refocus earlier. What's that about?
Yeah, that's a really key point right now. They've been selling off some parts of the business.
Divestitures.
Exactly. Board.org, I sell, and they announced the sale of Oxford Analytica and Dragonfly Intelligence for $40 million.
40 million. That's significant for a company their size.
It is. And this is happening alongside that big push for the unified PolicyNote platform. It really looks like they're trying to streamline, get back to basics, focus on that core AI-enhanced SaaS offering.
Which means PolicyNote really needs to succeed, right?
Absolutely. Future growth is becoming much more dependent on it. Now, their revenue for the last 12 months ending 2024 was $120.3 million. But we saw that Q4 drop 14% year over year.
Right. Partly divestitures, you said.
Partly, yeah. Pro forma, looking at annual recurring revenue, ARR, it was only down about 2% if you adjust for those sales. So maybe not as bad as the headline number looks. But what's also interesting is they hit their first full year of positive adjusted EBITDA in 2024.
Profitability.
Seems like a shift. Maybe focusing more on profitability and efficiency now rather than just chasing top-line growth at any cost. Future expansion hinges on PolicyNote driving organic growth.
Okay, that paints a clearer picture of the strategy. Let's pivot to Chapter 2, management evaluation. Who's steering the ship through all this?
There's been a change at the top recently. Tim Huang, the co-founder, CEO since 2013, he's moved to executive chairman.
Okay, still involved, but different role.
All right, focusing on strategy, mission continuity. The new CEO is Josh Resnick. He comes in with a background of extensive operating experience.
And the track record. Huang's tenure saw growth, acquisitions, going public, but also
coincided with a pretty substantial destruction of shareholder value. That stock price decline didn't happen in a vacuum.
Fair point. And Resnick?
His track record at FiscalNote is still developing, but it's marked by these recent actions. The divestitures, launching PolicyNote, hitting that positive adjusted EBITDA. They also made some key tech hires in April 2025, pointing towards product-led growth.
So new leadership navigating some choppy waters.
Yeah.
How are they handling the big challenges that stock price the NYSE noticed?
It seems like a multifaceted response. Strategically, the refocus on core AI SaaS we discussed, selling non-core assets.
Right.
Operationally, cost management is clearly a priority, hence the positive adjusted EBITDA for 6 straight quarters through Q4 2024.
6 quarters, okay.
Financially, they're talking a lot about paying down debt. And communication-wise, they're doing the usual quarterly calls, investor outreach, explaining the strategy.
But will it work?
That's the million-dollar question, isn't it? Success really depends on sustaining that profitability, getting back in compliance with the NYSE, and crucially rebuilding investor confidence.
And transparency is key for that confidence. How are they doing on that front?
Seems pretty standard for a public company, based on our sources. Quarterly earnings calls with details, investor conference appearances. The IR website has the filings, presentations, news.
Standard stuff. Any red flags on ethics?
They talk publicly about commitment to ethics, governance, follow the laws, NYSE rules. They put out sustainability reports. We haven't seen reports of any major ethical scandals in the sources reviewed.
Okay, so let's try to assess them. Honesty, capability, shareholder orientation. How do they stack up?
Honesty appears standard, no evidence to the contrary in the sources. Capability, Resnick brings operating chops. Recent actions show they can execute, like the divestitures and profitability push. But that past value destruction under previous leadership is a big shadow. And future success really hangs on this AI-centric strategy working out.
And shareholder orientation. Focus on profit, debt reduction sounds good.
It could be seen that way, however, and this is a big however, there was significant stock selling by both CEO Resnick and Executive Chairman Huang in early April 2025.
Selling when the stock is near its lows.
Exactly. Resnick sold over 4,400 shares, Huang over 34,000, at prices near the 52-week low.
That doesn't exactly screen confidence, does it?
It really doesn't. Now, there was some insider buying by others in March, but the selling by the top 2 leaders, especially at those levels, sends a very negative signal. It undermines the whole turnaround story and makes you question their belief in the near-term prospects and current valuation, adds a lot of risk for potential investors.
Yeah, that's definitely a concern. Wow. Okay, let's move to Chapter 3, financial health. Let's get into the numbers.
Right. Market cap, as we said, around $100 million, microcap territory.
PE ratio.
Trailing 12 months, it's around 9.3x to 10.4x. based on reported EPS of $0.07.
That sounds low for tech sensor.
It is quite low. Likely reflects that market skepticism we talked about. You compare it to, say, Accenture at 24x, IBM at 36x, FIS at 56x. It's way lower, though one source noted it's higher than some peers with negative earnings.
Okay, revenue growth. We touched on declines.
Yeah, FY 2024 total revenue was $120.03, down 9% year over year. Q4 2024 was $29.05, down 14%. And the 2 quarters before that also saw declines.
Management blames divestitures.
Partially, yes.
Yeah.
Excluding those, Q4 subscription revenue was only down 1%. Looking ahead, analysts are projecting maybe $96 for 2025, then $103 for 2026. So stabilization, maybe modest growth off this lower base.
And AR.
End of 2024, it was $107. That's down 15% year over year. But again, pro forma, adjusting for divestitures, it's only down 2%.
Okay, got it. What about margins? You mentioned positive trends there.
Yes, definitely improving. Gross margins are strong. FY 2024 GAAP was 79%, up from 70%. Adjusted was 86%. Q4 GAAP was 82%. Very healthy.
And operating margins.
Trending positive, partly because they didn't have that big goodwill impairment charge like the year before, which helps.
Right. Adjusted EBITDA margin.
FY 2024 was 8%, big jump from negative 6% the year before. Q4 2024 hit 11%, up from 9% in Q4 2023.
And net income. You said they were profitable?
Yeah. GAAP net income for FY 2024 was $9.5 million. That's a huge swing from the $115.5 million loss in 2023. Gives them a TTM net profit margin around 7.9%.
That's quite the turnaround on the bottom line. What about debt? You mentioned they're focused on deleveraging.
They are. Reduced senior debt by 44% in 2024. They ended the year with $35.3 million in cash.
But is the debt still a concern?
It seems so. The interest coverage ratio is low, only 1.43. That suggests the debt burden is still pretty heavy relative to earnings.
Free cash flow.
Info there is a bit patchy, even contradictory in the sources. One source showed negative TPM EBITDA, which conflicts with the positive adjusted EBITDA number. We'd really need to dig into the SEC filings for a clear picture of FCF.
Okay, and price to book.
Around 1.0x. Which is low, especially for tech SaaS, where you often see a premium. Again, likely reflects market concerns, lower than the peer average of 2.4x in one comparison.
So the big questions for a value investor.
Are
they profitable? Is the balance sheet strong?
Profitability, yes, recently. GAAP and adjusted in FY 2024 with improving margins. But sustainability is the question mark. Analysts project potential negative EPS near term. And we need to be careful about the quality of those 2024 earnings, any one-offs. Market skepticism shown in the low PE, and that EBITDA discrepancy highlights the need to understand the adjustments.
Okay, so profitable but maybe fragile. Balance sheet.
Under repair, I'd say.
Yeah.
Not inherently strong yet. That $40 in divestiture cash will help. The debt reduction is happening, which is good.
Right.
But the overall debt load versus earnings is still a worry, shown by that low interest coverage. Liquidity ratios, current at 1.12, quick at 0.94. They're okay, but don't offer a huge cushion. Paying down debt is good, but it also means less cash for aggressive growth.
Right, constrains their options. This really feels like a company at a crossroads. Let's shift gears into the second half, Chapter 4. Market sentiment. What's the street saying? What's the vibe?
The vibe is largely negative, frankly. You just have to look at the stock chart. Down 54% year over year, down a whopping 93% over 3 to 5 years. It hit a 52-week low of around $0.56 just last week.
Ooh.
Yeah. And those low PE and PB ratios we talked about, they scream market skepticism.
Any signs pointing the other way? Contrarian signals.
A couple, actually. Zacks upgraded them to a buy back in March 2025, and some technical analysis pointed to a potential pivot bottom, a buy signal, in late April. So little glimmers against the trend.
Interesting. What specific news is driving sentiment, positive and negative?
On the plus side, that positive adjusted EBITDA run, launching PolicyNote, the AI tools like StressLens, the incoming $40 from divestitures, new leadership appointments, that Zacks upgrade.
Okay. And the negatives?
Continued revenue declines, the NYSE listing notice hanging over them, that insider selling by the CEO and chairman, that really hurts sentiment. And Roth MKM recently lowered their price target from $3 to $2.
An analyst downgrade.
Yeah.
Let's talk about those analyst targets. You mentioned a big disconnect.
Yeah, it's pretty striking. A stock's around 64 cents, right? The average analyst target was way up there, like $294.03. The range is wide, $1.50 up to $4.72.
Whoa. That implies, what, like 360% upside?
Around 360, 370%, yeah, which is way, way higher than the average implied upside for their peers.
What does that huge gap mean? Are analysts seeing something the market isn't?
It could mean they expect a massive improvement that the market just doesn't buy yet. Maybe they believe strongly in the turnaround, the AI potential,
Ah,
or the targets are just lagging reality, maybe overly optimistic based on assumptions that won't pan out. That Roth MKM cut adds to the uncertainty. For value investors, it's a huge grain of salt situation. You have to do your own homework here.
absolutely. Analyst targets are just one data point. Okay, Chapter 5, Ownership Structure. Who owns FiscalNote?
Institutions hold a fair chunk, about $62.4 million in long value based on recent filings.
Who are the big holders?
A lot of it is index funds. Vanguard Russell 2000, Fidelity Total Market, Schwab Small Cap ETFs, that kind of thing. Passive money tracking indices.
What does that mean practically?
Means demand is partly tied to just being in those indexes. If they fall out, could be automatic selling pressure. Less about active managers making a conviction bet. There are some smaller active funds too, but passive dominates. Activities mix some buying, some selling, some new positions, some closed out.
Okay, and insiders. We know about the recent selling.
Right. Key insiders are Huang, exec chairman, and Resnick, CEO. We don't have exact percentages from these sources, but that early April selling is the big story. Huang selling over 34,000 shares, Resnick over 4,400 near the lows.
Contrasted some buying in March.
Yeah, two other insiders, Jane and Nilsson, bought shares in March. So it's not all selling, but the top leadership selling at the lows is, well, it's concerning. You really need to watch the Form 4 filings closely here.
Definitely. What about concentration? Is ownership widespread or tight?
About 155 million shares outstanding, float around 115 million. That suggests maybe 26% is held by insiders or strategic investors. So insiders have influence, but the majority is public float. Need more 13F digging to see how concentrated the institutional ownership is among the top holders.
And corporate governance. How does ownership tie into that?
Well, they say they're committed to high standards, following in the rules. The leadership transition seemed orderly. Wang staying as exec chair keeps his influence, though.
For better or worse?
Could be either. You'd look at the proxy statements, the DFF 14A for details on the board, pay, shareholder rights, and that NYSE listing notice is a direct governance issue meeting the minimum price requirement.
Right. Very direct. Okay, Chapter 6, Risk Assessment. Let's do the SWOT analysis. Strengths, weaknesses, opportunities, threats.
Okay. Strengths. Niche market position, growing AI focus, those established brands like CQ, high recurring revenue base, strong gross margins, recent profitability.
Weaknesses.
History of shareholder value destruction, recent revenue declines, inconsistent profit history before this last year, microcap status, balance sheet worries, debt, risk tied to the PolicyNote transition succeeding, that insider selling, and the NYSE delisting risk.
Opportunities.
Favorable long-term trends in RegTech, AI growth potential, PolicyNote adoption driving growth, gaining share in a fragmented market, maybe ESG focus helps, improving profitability further, maybe even becoming an M&A target down the line.
And threats.
Intense competition, PolicyNote failing to gain traction, financial instability if the turnaround stalls, macroeconomic headwinds, regulatory changes impacting their business, the delisting risk, execution risk on the strategy shift, and potential trade policy impacts, like tariffs.
Let's talk about that hypothetical. New U.S. tariffs in 2025. Good or bad for FiscalNote?
Counterintuitively, it could actually be a net opportunity for them.
Really?
Well, new tariffs create complexity, uncertainty. Businesses need to understand the impact, track changes, figure out supply chains. That drives demand for policy intelligence, regulatory tracking, exactly what FiscalNote does.
Especially with that new tariff tracker product.
Exactly. It directly addresses that need. So increased trade friction could boost demand for their services.
Any downsides?
Sure. If tariffs cause a major economic slowdown, clients might cut budgets, which could hurt FiscalNote, and maybe minor operational issues for them. But overall, the increased need for their specific kind of intelligence likely outweighs those risks. Net opportunity, probably.
Interesting dynamic. Okay, let's bring it all together. Chapter 7, brief conclusion and the end hook reveal.
All right. So synthesizing everything. FiscalNote is in an understandable business in a growing industry, but their specific long-term prospects are uncertain. New management, mixed record concerning insider selling. They're recently profitable, which is good, but revenue's been falling and the balance sheet needs work. Market's deeply skeptical. Analysts are way more optimistic. Big disconnect there. Lots of risks, but also clear opportunities.
From a pure value investing perspective, applying Buffett's principles.
Understandable business. Mostly, yes. Favorable long-term prospects for this specific company. Uncertain. Able and trustworthy management. That insider selling really puts trustworthiness into question right now. Attractive price, margin of safety. Despite the low multiples, the high risks and uncertain intrinsic value make that questionable for a traditional value investor.
That was bottom line.
It looks like a high-risk, high-reward speculative situation, not your typical value play at this point. Might appeal to investors with high-risk tolerance, deep industry knowledge, and strong belief in the turnaround. Conservative value folks should probably look elsewhere.
Makes sense. And the end hook. What are we teasing for next time?
Well, this whole area of AI meeting policy intelligence is fascinating, right? The competitive landscape itself is worth a closer look. So next time, we're planning to dive into the specific competitors in this space, see who's doing what, and look for potential disruptors.
Oh, interesting. Yeah, definitely want to hear that. So if you found this deep dive useful and want more like it, make sure you subscribe to the Stock Analytics AI YouTube channel. We'll keep bringing you these detailed breakdowns.
And just the standard disclaimer. This is all for informational purposes,
Yeah.
based on research up to today, April 29th, 2025.
Yeah.
It is not financial advice. Do your own research. And yes, AI tools helped us synthesize info from the sources for this discussion.
Right.
So that wraps up FiscalNote, that intersection of AI and policy. Definitely a space to watch. And like I said, next time we'll get into the competitive dynamics more deeply.
Okay, looking forward to it. And that leaves us with a final thought for you, the listener, to mull over. As AI keeps weaving itself into pretty much every industry, how do businesses strike that crucial balance, the balance between powerful tech solutions and irreplaceable human expertise, especially when navigating really complex, ever-changing areas like global policy and regulation? Something to think about. Thanks for joining us on the Deep Dive.